So today, I have the pleasure of having a conversation with Brandon Brooks, who's currently the GP of Overlooked Ventures. Um, and I think what's interesting is that they are a new firm um, that is focused on finding founders that are overlooked by the traditional paradigm of venture capital. And he's also been the founder and CEO of Inventrify, which is essentially, to put it simply, a software tool to help invest in your community through outreach and through direct investment in businesses. It's pretty interesting. And he's also currently serving on the Tech Council for Columbia, South Carolina. And absolute pleasure to have you here today, Brandon.
Yeah, thank you. It's my pleasure. I'm happy to be here, and just happy to be having these conversations and hopefully bringing more awareness to overlooked founders.
Absolutely. So could you just give us a quick story of how and your co-founder, Janine, met? I think both of your stories is super interesting. She's a badass, she scaled and sold her legal tech startup Next Chapter while raising 4 kids, which is insane. I think my mom's cool with for doing what she's built with her career with 2 kids. So I can't imagine what it's like with 4 kids. So just tell us, how did you meet Janine? How did you start Overlooked? What's the story there?
Yeah, so it's really interesting. We met on Twitter and then early days of Clubhouse, the
Oh,
earliest days
wow.
of Clubhouse.
Huh.
Yeah. So that was pretty cool. We were both saw kind of post George Floyd and the brutal murder of George Floyd. We both kind of were looking for ways that we could have bigger impacts within our communities. I, as a Black founder, I found my company because I wanted to have an have a outsized impact on underserved communities that I come from. I come from a very underserved community in Pittsburgh, Pennsylvania. And so that's why I started my company. And I had no idea what venture capital was when I first started, which was really, I didn't even know what a startup was, to be honest with you. But you know what? I started to learn more about venture capital over that time. And I said, wow, we really got to create more opportunities for people. So I wanted to start my own individual fund at one point, probably a smaller fund, 5 million, 10 million. And then as I was getting more heavily involved in Twitter. And then as I got on to Clubhouse in the earliest days when there was like, I don't know, maybe 5,000 people on it.
So
I
is
hear
this like
this.
June 2020?
Yeah, probably right around there. Yep, right around June 2020.
Okay.
I see this person, Janine Sickmeyer, on there talking. And she's saying a lot of the same stuff I'm talking. We're on a lot of the same panels on Clubhouse and having the same conversations on Twitter. And to be honest, I really became a huge fan of Janine's. Like, I was like, this person is unbelievable. I can't believe what she's doing. She's talking the talk, but she's walking it. She was writing angel investment checks right after her exit into Overlooked Founders, essentially. And so then me and her started to build a relationship, just talking with each other, after these panels were over, in the DMs, talking on Twitter and following each other. And one thing led to the next. She was kind of like, where are you at on starting your own fund? Because I'm thinking of starting my own. And I was just like, well, it's difficult. It's hard. And, she was like, well, if there's any way I can help, let's, let me know. And I said, well, like doing it together. And that led to, getting to meet up in person, getting to spend more time, building more of a relationship. Next thing we know, we said, let's start Overlooked Ventures together. Let's go in on this. Let's build our, put our community, our resources, our network together and build OV.
Okay, I have to ask, what was the first meeting? Like, where did you meet? Was it at a diner or something? Like, what, or was it super fancy? This is like, we need to know the story here.
Yeah, nothing super fancy. So Janine's based in Columbus, Ohio. So I went to Columbus, went to go meet up with her, and we were just kicking it. We were just chatting, relaxing. I think we ended up going to some rooftop bar in Columbus. Nothing fancy. I mean, neither of us has that type of personality background or anything. We just wanted to kick it and everything. And so yeah, then we talked more about it there.
Yeah, that's cool. I think so. So just one point about Janine. I think I actually may have pissed her off a little bit because I think she was expressing her opinions very strongly as she always does, and that's why I respect her. And they said something against it, but like she is so cool because she, I think, actually believes it. I think in our industry, everyone or sorry, more a fair bit of people say a lot of things, but I don't think they mean them. I think it's a financial arbitrage opportunity for a fair bit of people, but she is a believer. And to see her like writing checks and following through on what she believes in is pretty cool. And yeah. So
Yeah,
yeah,
I'll say real quick about Janine.
yeah.
There were some other opportunities I had maybe to start a fund or with other people or whatever.
Hmm.
And I just, like you said, it was more of people looking to take advantage of an opportunity.
Hmm.
Janine was one of the few people that I saw that not only was she really believing it, I mean, she stands behind it.
Hmm.
She's made it her mission. I mean, just like me, and we have some very intimate talks personally. She does some, she says stuff online. I say stuff online, but it's hard to meet people who are genuinely about it, and Janine is as about it as anyone can get, and I'm so grateful for that.
Yeah, absolutely. Well said. So I wanted to read a couple of quotes or that I found interesting. So the first quote, so both of these are from Samil Shah, who's a GP at Haystack. Obviously, he has said two very interesting things in his blogs about the topic that we're going to talk about, which is portfolio construction. One, which is the associations with founders and the logos of the companies stick around for better or for worse. And the second quote, which is portfolio construction is what our GPs, sorry, one second. Yeah, is what us as GPs are in the business produce. It is our core job. The job involves other cool things like hearing pitches, helping founders when we can. But at the end of the day, at the like we it's our job to build a portfolio of uncorrelated assets. So I quickly wanted to get your thoughts on those two, understand how you think about and how you define portfolio construction quickly.
Yeah, so portfolio construction at the end of the day, I think is what sets GPs apart, or
Mhm.
what sets different VCs apart, and
Yep.
VC funds and firms and everything. And so as VCs, to take a step back real quick, we have to raise money from LPs, which are limited partners, right? And those limited partners can be institutions, high net worth individuals, family offices, et cetera, et cetera. Uh, how we define our portfolio and our thesis is generally if they choose to, and if these LPs choose to invest in us or not. Sometimes it's based off of reputation, or prior relationships, etc. But as new GPs, as emerging fund managers, that's really how you do it. And so what I thought was what I think is really interesting is everybody tries to put this down to a science. Like
Mm.
they try to show stats, facts. It's, well, if we invest in this amount of companies at this valuation, et cetera, et cetera. And the truth is, like, that sounds great. And if you want to go work for, one of these large hedge funds, that may be a fantastic strategy. In early stage venture capital, you cannot do that. We look at portfolio construction completely different at Overlook Ventures. And we say, not only does our portfolio construction involve, hey, we want to invest in this amount of founders, hey, we want this amount of ownership. Our portfolio construction comes down to, what do these founders need? The historically advantaged founders that get invested in are completely different than the founders that we're looking to impact. I mean, it's just, you have a different network. Like a lot of these founders that have been historically funded, maybe they went to Stanford, Harvard, whatever. They could have raised a friends and family round. They could have raised, 500,000, a million, whatever, a friends and family round. These people we're talking to don't have that ability. They just don't. And so if you try to put your portfolio construction around somebody, around a general thesis, you're now grouping in the same amount of people who could raise that friends and family round and the people that couldn't, right?
Mm-hmm.
And so we take a completely different approach. But Samir's absolutely right. There's certain aspects of it that you have to think about. And I think I laid ours out on a Twitter thread the other day.
Yeah, which I'll be happy to break down. But yeah, I think yeah, it's very interesting that you use the phrase friends and family round, because if you listen to like podcasts, and I think of just like inception stories, and the traditional founder has some story to the effect of, I raised from friends and family. And I think if you're from a background where your parents or family are uncertain about making rent payments, or are in debt, or have terrible credit, how is that expectation rational? And I think that's what you're saying. Like, you are a tool to address that irrational expectation. I think that's beautiful. Your first tweet essentially states the constraints, which is invest early, pre-seed/seed, first check-in, target ownership is 6 to 10%, pro rata rights, 45 to 48 startups, and 50 million fund size, if I understand correctly. So how did you reach this conclusion? Right? What was the process of you setting these constraints? And basically, how did you arrive at this?
Yeah, so Janine and I are both previous founders, right?
Mm-hmm.
And still founders to this day. Janine's company Next Chapter, mine Inventrify. And so we understood, and neither of us were ever able to raise a friends and family round. And actually, neither of us raised venture capital funding, anyways. But we saw the potential of being able to back founders like us, because both of us have now ran successful companies. And so that was step one, is understanding that from a founder and an operator standpoint that comes from these overlooked backgrounds. What is step one that they need? That's what we identified. Then we were able to build the blocks off of that. We said, we could go with maybe a $5 million, $10 million fund. But the problem with that is overlooked founders face different challenges as they go. One of the challenges is, okay, if you're able to raise a pre-seed round, what about your next round, the seed? A $10 million fund, a $5 million fund may have certain constraints of participating in a meaningful way on both of those rounds. We said, we don't want to do that. We want to go ahead and raise a larger fund so that we can participate in the subsequent rounds, maintain our ownership of that company, and then also help the founders raise further. So then that's why we went with $50 million. But then if you look at the number of companies, we don't want to make a small impact. We're not looking to fund 10 companies and say, oh, well, these 10 companies are the outliers, not the actual case for why we should all be investing in overlooked founders. We want to make the case. And that's why we went with 45 to 48 companies, which is going to be our fund one. And then our average check size is around 100,000 to 500,000, just because of the valuations that we see early stage with overlooked founders. But we're not so much worried about average check size. We're more so interested in the valuation and then getting our ownership in there. And so our average check size can fluctuate, and that's why it's really between 100,000 to 500,000 so far. But that could change on either scale as well.
Yeah, Yeah, thanks for breaking that down. And to get to your point about investing up from pre-seed to seed, I think that's a separate question. But before I do that, what is your median check size? Because you said that it ranges from 100,000 to 500,000 approximately. What does the median check
We're
size look like?
we're right around 250
Oh, so the mean
for
is
median.
actually equal to the median. Interesting.
Yep.
Huh.
Yep.
That's very interesting. It's one of those math problems you think you'll never see in your life. Um, so would it be fair to characterize what you're doing as essentially a pre a fund with a sort of pre-seed bias, with the first check bias, but with the fund size of a seed fund, which tends to be bigger than a pre-seed fund?
Yeah, absolutely. So I think our biggest thing, and Janine has said this online a few times, we want to be the friends and family round that you never had as an
That's the one,
Overlook
yeah.
founder.
Mhm.
And so that's what we want to do. We want to get in there, the earliest stages, help you build it. Like both of us have built companies from the earliest stages. We can get in the trenches with you, and you can ask any one of our portfolio companies. We do get in the trenches.
Mhm.
And so we go from that first check in a lot of times, get there, work with you to build it up to where you're seed ready. Then we can also participate in your seed round. And then we can help not only participate in your seed round and help continue helping you build it because we've seen it from day one, basically.
Mhm.
We're also connecting you to our network, our community of other VCs, other founders, other CEOs, other C-suite execs, other later stage founders, et cetera, so that we can get you to the A round now, and then subsequent and further along. And even though we're very early in our cycle as a fund, we're starting to see that now. We're starting to see some of our pre-seeds that are going on to seed, and then some of the seeds that are going on to their Series A. We actually have our first one getting ready to do that, or actually starting to do that now.
Wow, amazing.
Yeah.
I wanted to quickly ask and break down, what does getting in the trenches mean? I'm sorry if this is coming across as mechanical, but I just wanted to understand, what does that look like? Like, what is the frequent call for help look like? Is it about how the cap table looks like? Is it helping structure that for the next round? Or is it around customer acquisition, industry partnerships? What's the number one thing that you've experienced in terms of, hey, this is what we need help with, get in the trenches with us?
Yeah, so I'll say that no startup journey is the same. And so we do it all of what you mentioned there. Some of the stuff is we have a great website developer that we work with. We've helped some of our portfolio companies get their website built. I mean, literally down to that, we've helped our portfolio companies building a website out.
Right.
I've told our portfolio companies, if you need us for sales calls, we'll hop up. If you don't have a sales team yet because you're still working, you're still looking at, we'll do that. If you need help with interviewing applicants, Janine just helped one of our companies interview applicants for a marketing position for that company. Janine did the interview for that. I mean, and then all of the VC stuff, all of the how to manage your cap table, how to, put together your cap table. We do that as well. But we literally, as operators of startups ourselves, we know where you may need us. And so we let our portfolio companies know you have a 24-hour, whatever you need, access to our cell phones, emails, whatever is most comfortable for you. Hit us up, let us know what you need, and we'll be there for you, whether that's sales, marketing, strategy, etc. We do it all.
And I wanted to ask you, what is the difference in what a company looks like when they usually come to you, right? Which is like pre-seed or seed-ish, right? They're not really at the seed stage. What does that company look like versus something that's already at seed, but might be close to transitioning to see a Series A check?
Yeah, so it's funny because there's not much difference to be honest with you with
Hmm.
the companies that we focus on with Overlooked Founders.
Hmm.
A lot of them are the same.
Hmm.
I mean, just it's wild because I've seen startups that are getting Series A funding that are
Hmm.
traditionally funded
Hmm.
that are not as far along as some of the pre-seed or seed stage startups that we get in our deal flow.
Can
And
you
the
like,
reason is
sorry.
access to network.
Hmm. Sorry, can you like quickly dig into that? Because I've heard, I mean, I don't think anyone said this explicitly. I think that would, piss off their business contacts and, create enemies. But what does this look like? This gap in progress levels, like, the startups. I mean, I'm not going to say names, but we've heard of these stories, right? With where it's like, how are they raising a 60 or $50 million Series A, whereas like there's you've got like $100,000 in ERR, but like can't raise money. I mean,
Yeah. I,
what does that look like from your view?
It looks like what you just said there. I
Yeah.
mean, literally, we have companies that have solid ARR that have. We have one company that has non-dilutive funding from NASA and other great partners,
Hmm.
and they didn't have the network to raise a seed round. And when they saw Overlooked Ventures on Twitter, they felt they told us that they felt like they connected with us, that hey, we're overlooked, that's who we want to speak with and work with.
Hmm.
And now that company is going on, getting ready to go on to do some pretty amazing stuff. And so it's just they don't have the network. That's all it comes down to. I mean, a lot of these companies, I kid you not, that we're seeing pre-seed seed have amazing traction already, whether that's ARR, MRR, whether that's customers, LOIs, whatever you want it to
Hmm.
be. Like they have amazing traction already, but they don't have the network.
Hmm.
That's the only missing piece.
Hmm.
But then at the same time, I've seen companies that have the network, but don't have the AR, don't have the
Hmm.
MRR, don't have the LOIs, don't have a product,
Yeah.
pre-product, and are raising it at higher levels because they have the network. And it's kind of like throw money at it, let's see if it'll work. Where we're saying, hey, this is working, let's
Hmm.
put money towards it to get it to working better and more efficiently.
Yeah, or I think like in VC speak, this to characterize the problem which that you're talking about or we're talking about is essentially your portfolio would be considered extremely high signal risk, but just from like a business standpoint, it's fine, like or even better. Um,
Yeah.
so given this, how are you solving for signal risk? Or yeah, because it's really to put it in normal people speak, it's just perception. How are you solving for that? Like, what's your strategy when it comes to like PR? Or are you not having a strategy? How do you think about that?
Conversations. I mean, talk about it. This is literally, it's why I'm on Twitter. It's why I'm on Twitter.
Right.
Like people think like I want to be there. Like that's just, and I've got stuff I could go be playing basketball right now. I could go.
Right.
It's talk about it nonstop, and then show the results. I mean, like we should. One of our earliest portfolio companies was just featured in TechCrunch for the work that they're doing today, this morning.
Huh.
Lalo. And it's like we just want to show the results. Like, hey, here's what we've been saying. Here's what we're
Hmm.
talking about. Yeah,
Hmm.
we're going to continue the conversation, but here's also the results of it and what they're
Hmm.
doing. Like maybe other people should be paying attention to this. So
Hmm.
it's just having the conversation, showing the results.
Right. Yeah, well said. And I wanted to ask you, do you see yourself staying at a $50 million AUM? Like, what will your next fund look like? Is it
Uh, we I will say that we are working on it, and we may have some
okay?
interesting stuff. But what I see us in 10 years
Hmm.
is I see us being. We want to compete with Sequoia. We want to compete with A16Z.
Hmm.
We want Overlooked Ventures to be the number one fund in the world,
Hmm.
and we want to show people why we're better than them. We'll work with them. I love the work that they do. I love how they
Hmm.
paved this way, but they haven't done enough, and we're going to do it.
Well, I think like I don't know, when I started like just looking at investing stuff when I was like 15, I thought it was like, oh, this like magic thing where you make money and like it's about numbers. And after like doing, I mean, trading stocks and all that, it's ultimately it comes down to managing your psychological biases as well as recognizing the psychological biases that are at play around you. And I think you are well positioned to capitalize on your environment. That's all I'll say. And I'm sorry, I wasn't trying to trip wires. I didn't realize you were raising another fund. I had no idea. So sorry about that. Um, the second thing that I wanted to explore from your tweets was your counter positioning, which you mentioned earlier, against measuring fund success by follow-on financing. And to basically make this clear, what is the probability that if Overlooked invests in a pre-seed or slash seed, what is the probability that that gets to a seed or a series A, series B, series C, and so forth. I think modeling for public outcomes is a little tough from the standpoint, but it could be done theoretically. Why is it that like you're essentially saying we don't think about that? And you had some interesting phrasing that I actually don't want. I want you to like take the stand and explain it fully.
Yeah, I guess if you talk about the graduation rates, the standard way to think about it is, hey, this company got 60%, 40%, or this VC firm got 60%, 40% of their companies to go to Series A, and then 20%, 24%, whatever to Series B, and et cetera. And what I think is VC firms end up using that number to raise more money from RLPs or from limited partners. But the data actually shows that's completely false. It's like, not only is it not a narrative you should use, it's counterintuitive to the narrative. The more that you have that do not make it to those next rounds, the higher probability of multiples for the fund that it will return. Why? Because you're taking bigger risks, right? And it's the power law. It's like the power law coming into effect, and which we all know in venture capital. If Babe Ruth hits a home, it's the Babe Ruth rule, and we've heard about this several times. But it really shows that this is why you should look at overlooked founders, overlooked markets, overlooked everything, instead of trying to take the safe bets. And so what's happened these past, probably almost 10 years, is we've tried using these statistics, the data, to try and do this like a hedge fund. And venture capital is not a hedge fund industry. You need to look for forget these stats, forget the 60%, 40%. Look for the outliers, the overlooked, and that's where you're going to find alpha and actually have the outsized success. And so that's what we see and what we're starting to see in OV. We're very early in our fund, just a year now, but we're already starting to see some success, and it's because we've seen we've had this mindset from day one. This isn't, hey, we got to change with the markets. Our mindset today is the same as it was a year ago, and will be the same 10 years from now.
Yeah, I think so. Just quick point here. I think it's very interesting that you point out and are saying that, evaluating the performance of venture funds from using the risk metrics, right? You can't use a Sharpe ratio to determine that. You can't do that. And it's important to point this out. The reason why it doesn't work is because in those markets, in public equities, bonds, derivatives, those are in some cases 8-hour markets, and in some cases 24-hour markets. I think currencies are a 24-hour market. So in that case, liquidity drives price action. And this is not an illiquid market, right? Venture isn't a particularly liquid market. It is extremely illiquid. And the thing that drives price action is signal risk, again, which is what you're solving for. Wow, this is fun. Actually, like
Yeah.
figuring something out. This is because I was
Yeah.
like, what the hell is he saying? I don't I didn't understand your tweet. Okay, when I first read it, I was like, doesn't this make, but like when you said it, it's making sense now. This is great. I'm actually learning now. This is awesome.
Thank you. Thank you.
Yeah,
Thank you. I hope so.
yeah. You know the moment when you actually like figure something out and it just clicks? I think I just had that. This is great. I've never had this on a podcast. It's awesome. Um, so one question I wanted to ask, outside of portfolio construction questions, is in terms of building capabilities for founders. Obviously, the first thing you're solving for is signal risk, right? Which is through a combination of demonstrating milestones that are with the portfolio you've already built, plus, just speaking out. Do you see an opportunity for other tools? Like one, I was just like walking home from buying groceries or whatever, and I was just wondering, like, I think a great VC firm would be someone if they just like were like a mass buyer of AWS credits and GitHub credits or whatever, right? Like just uh, mass bought all that and just sold it back to startups in the form of equity or reduced cost or whatever. Like that, what examples can you think of in terms of capabilities for founders?
Yeah, so that's interesting. So I think that there's endless opportunities here.
Of
Like
course.
there's endless opportunities to iterate
Yeah.
on what we feel like venture capital founders, any of this should be.
Mhm.
And so I look to what Sequoia did with the Sequoia Fund. I'm a
Mhm.
huge fan. I
Mhm.
love what they did, and more popularizing the RIA model, which years ago venture capital actually lobbied against the RIA model. But
Mhm.
now, which is registered investment advisor, but
Mhm.
now Sequoia has more popularized the Sequoia Fund and what they're doing. Now, there's not many other funds out there that could do this in a significant way. There's some other funds that do it, but not in the same significant way that Sequoia is doing it. But I do actually think we'll see more going that way. And so what I think and what I encourage people to do is think outside the box to that. Like I've actually thought of something I've thought about is the opposite of the Sequoia Fund model and saying, hey, instead of trying to go later stage, what if you paired a venture capital fund with an equity crowdfunding platform? And you can do this as a broker dealer, which is something that came in after the 2012 Jobs Act with equity crowdfunding. In 2015, they actually made some amendments. And so a venture capital fund could technically launch its own broker dealer site, get the market involved. And by the market, I mean retail investors in the same way that a equity crowdfunding platform does. Maybe you're getting them involved earlier with your lead check, and then you're taking it later to the later stage. And does that send a little bit of a signal with saying, hey, the market is involved earlier, or customers are involved, people are involved that are outside of our traditional network? And if they're involved, they're going to continue supporting. I mean, you're just more likely to support any type of business that you're an investor in, period. I own Apple shares and I only use Apple products. I'm talking on my Mac right now. I'm going to go as soon as we're done work on my MacBook Pro. And then I've got my iPhone here. I'm in my AirPods. I'm more likely to support Apple because I'm an investor in Apple, period. So what if we do that for early stage startups and then get everybody through the process and continue the venture capital process? So that's something interesting to think about. But the bottom line is we can iterate on everything. It's all down to imagination and the work that you're willing to put in to make sure it's legal. And that, that's a big part. But yes.
I think that's awesome, because another problem I was just like thinking about like was what would a Vanguard 500 or a S&P 500 product look like for early stage high risk equity? And what you're describing would be some version of that, which is very interesting. Wow. Huh. That's generally interesting. It took me a second to process that. Do you mind if I ask a bit of a cultural, sort of societal question? I think it is relevant to what we're talking about. So there is a position that's been taken by certain firms, and since I'm in the Midwest, I can testify to this, of we don't invest, we invest in the best, which is a very, very, very subtle, but not that subtle snide of we don't really care about diversity. I'm gonna let you take the stage and just share your thoughts on that, because it's very real, and I'm sure you can testify to that too.
Yeah, they don't. I mean, point blank period. We can look at every statistic. They don't. The overwhelming majority of this industry does not invest in anything other than white male founders, and the vast majority of those white male founders went to Ivy League schools.
Mm-hmm.
If what was it? I just read the other 40% of VCs themselves are white males that went to either Stanford or Harvard.
Mm-hmm.
It's a network effect. All of
Mm-hmm.
it is a network effect. And we've just held back innovation, we've held back excellence, we've held back so many different things because diversity solves different problems. I mean, I'm from an underserved, I'm Black, I'm from an underserved community. I view the world and I view problems differently than a white male that went to Stanford or Harvard. But Janine, my partner, she views the world differently than I do, and differently than those white males that went to Stanford did, because she's a white female who did not grow up in with that, within that type of community that those same Stanford and Harvard people did. So I think we can all solve such different problems if we actually have the opportunity to do so, because we all see, and that opens up different markets. That opens up alpha. That opens up different return profiles, outside returns.
Yep.
And that's what we're trying to, Overlook Ventures I would have no need to exist here today.
Mm-hmm.
This isn't a vanity project for me.
Yeah.
I would have no need to exist within this industry today if I didn't truly believe that they were all investing in the best founders. They're not. They're all investing within the best founders in their network. That's the caveat they forget to put there. If you expand it to outside of your network, now you can truly start investing in the best founders. And that's what we bring as Overlook Ventures.
Yeah, I think I think there's a bit of confusion. So I was so coming from India, there was that's a different discussion in terms of diversity. But coming here, it was like, what is, because it gets religious on both sides. But I think the bottom line is it's about having an uncorrelated set of bets, right? And to quote Denzel Washington, it's not necessarily about race that plays a factor, but it is about the culture. And I think taking an interesting snipe at it. So thank you for sharing your time. Is there anything that you want to share? Any comments that you want to make before we wrap up for today?
No, I appreciate you. I appreciate you having this conversation. I appreciate anybody that wants to have this conversation. We need more of it. We need more of us. We need more diversity. We need more diverse thought processes, more diverse viewpoints, more diverse everything. And hopefully we can be a part of that at Overlook Ventures and bringing these conversations to light. And I appreciate the work that you're doing to do the same. So thank you.
It pales in comparison to what you're doing. So I'm humbled to even be a part of the conversation. So thank you so much for doing this, Brandon. Pleasure.
Pleasure.